Most people think they're saving money. They're not. They're slowly watching it disappear. Every year, inflation quietly destroys purchasing power, while banks hand you tiny interest payments and call it growth. Your account balance may go up, but the real value of your money goes down, and that's exactly why the wealthy don't keep most of their money sitting in cash. They move it into assets that survive inflation, economic crashes, and currency devaluation. The average person saves money. The rich store wealth. And in this video, we'll break down 6 powerful assets the wealthy use to protect and multiply their money, while everyone else gets poorer without realizing it. First, precious metals. Gold, silver, and platinum have protected wealth for thousands of years. Unlike paper money, governments can't just print more of them overnight. That scarcity is what gives them power. Every time inflation rises and currencies weaken, precious metals tend to become more valuable. That's why wealthy investors always keep part of their portfolio in metals. Gold especially has become a symbol of financial protection during uncertainty. Decades ago, gold cost only a fraction of today's price, while currencies lost enormous purchasing power over time. Gold doesn't rely on trust in governments or banks. It holds value because the world agrees it's valuable. And if buying physical gold sounds complicated, investors can still gain exposure through gold ETFs without storing bars or coins themselves. Second, industrial commodities. These are the raw materials that power the modern world. Copper, nickel, lithium, cobalt, and silver are essential for technology, batteries, construction, and energy systems. As industries grow, demand for these materials rises. Take electric vehicles, for example. The global push toward EVs massively increased demand for battery metals like lithium and cobalt, driving prices upward. Unlike trendy products that come and go, industrial materials are tied to real-world production and infrastructure. That gives them long-term relevance. Most people won't buy and store physical commodities, but investors can still benefit through mining company stocks, commodity ETFs, or resource-focused funds. Third, safe haven currencies. Most people never think about currencies as investments, but wealthy investors do. During global crises, money flows toward stable countries with strong economies and political security. That's why currencies like the Swiss franc are considered safe havens. Switzerland built a reputation for stability, banking security, and financial discipline, making its currency attractive during uncertainty. When weaker economies struggle, stronger currencies often gain value. The rich understand that protecting wealth isn't only about investing in companies or assets. Sometimes it's about simply holding money in stronger systems. Today, even average investors can gain foreign currency exposure through currency ETFs and Forex platforms. Fourth, government-backed securities. Modern currencies are no longer backed by gold. Instead, they're backed by trust in governments. That's why treasury bills, notes, and bonds are considered among the safest investments in the world. Governments are usually the last institutions expected to fail because entire economies depend on their stability. While these investments don't produce explosive returns, they offer protection, stability, and predictable income. In uncertain markets, that safety becomes extremely valuable. Wealthy investors often use government securities to preserve capital while balancing riskier investments elsewhere in their portfolios. Fifth, value stocks and dividend funds. When most people hear stocks, they think of risky tech companies and wild market swings. But not all stocks work that way. Value stocks are businesses with strong fundamentals, consistent demand, and stable profits. These companies often operate in industries people will always need, like healthcare, manufacturing, utilities, or consumer essentials. Many also pay dividends, creating passive income while investors hold the stock. Over time, dividend reinvestment can become incredibly powerful because it compounds wealth automatically. Instead of trying to gamble on the next big startup, wealthy investors often focus on reliable businesses that steadily grow over decades. And for people who don't want to research individual companies, dividend ETFs and mutual funds make diversification much easier. Sixth, real estate and land. Land has been valuable since the beginning of civilization because it's finite. More people are born every year, but no one is creating new land. That simple reality keeps demand high. Real estate also serves multiple purposes at once. It can generate rental income, increase in value over time, and protect against inflation. Historically, property prices tend to rise over long periods even after market crashes. And despite what many believe, real estate investing doesn't always require huge amounts of money. Real estate investment trusts, or REITs, allow investors to own shares in large real estate portfolios with relatively small investments. This gives ordinary investors access to commercial buildings, apartments, healthcare facilities, and shopping centers without buying entire properties themselves. And finally, collectibles. Rare watches, vintage cars, artwork, luxury handbags, comic books, and limited edition items may seem unusual as investments, but scarcity creates value. The rarer something becomes, the more collectors are willing to pay for it. Wealthy collectors spend millions on unique items because these assets often hold value independently of traditional markets. A rare collectible can appreciate dramatically simply because only a few exist in the world. Even today, smaller investors can enter this market through online collectible platforms and fractional ownership systems. The real difference between the wealthy and everyone else is mindset. Most people focus only on earning money. The wealthy focus on storing value. They understand that inflation quietly punishes people who keep everything in cash. They know that true wealth comes from owning assets that survive economic uncertainty and appreciate over time. Precious metals, commodities, strong currencies, government securities, value stocks, real estate, and collectibles all serve one purpose: protecting purchasing power while creating long-term growth. Because in the end, the biggest financial risk isn't losing money fast. It's losing it slowly while believing you're safe.